by now, maybe we're very close to $10,000 an ounce to go back to what historically was the portion of the currency supply that the U.S. gold covers. But the U.S. Gold, the gold that is supposed to be held in trust for all of the U.S. citizens, is not going to be used to back private bank credit. Banks, they have some rules that they have to live within, and the Federal Reserve can tighten up those rules or loosen up those rules. But there are rules that govern that. But the U.S. has never guaranteed the bank credit that they create, and that's most of the dollars that exist.
Gold has this one trait that makes it different from anything else we call money. Its supply grows at almost the same pace as the human population. That's why its purchasing power has stayed remarkably steady for thousands of years, from ancient Rome right through to today. Sure, the price moves up and down in the short term, but it doesn't collapse the way paper currencies always do. Now, here's where people usually get it wrong. You'll hear folks run numbers like, what price would gold need to hit if it backed the entire money supply? M2? Maloney says that's a dead end. The Fed doesn't back all bank credit. Around 92% of money is created by commercial banks, not the federal. The central bank only backs the physical currency in circulation. And historically, that's what gold was tied to. If you run the math on that, gold would need to be somewhere around $9,000 to $10,000 an ounce to cover today's notes fully. And there's precedent for this. Before the Depression, U.S. notes were 100% backed by gold. You could redeem a bill for gold coins. It was a self-funding system. The Treasury bought new gold, issued notes against it, and the metal guaranteed the promise. But once the reserve ratio slipped to 40%, most notes were no longer fully backed. And that's when the system cracked. Under Bretton Woods, it got even looser, dropping to about 8% before Nixon slammed the door in '71. That's why Maloney sums it up bluntly: gold standards fail. Not because gold doesn't work, but because governments always cheat on the ratios. And once the lie gets too big, the whole thing breaks. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
It would be interesting to plot this growth against inflation, except you'd have to pick some sort of mean between the way the government used to measure inflation and the way they measure it today, because what we've shown lately, the difference between the shadow government statistics. There are short-term changes in velocity and some other things that cause inflation and lack of inflation. But ultimately, this is where it comes from. And you said if it grew equally with the population, it would be a flat line. Well, that's what gold does. We make babies at about the same rate that we mine gold. And that's the reason it has constant purchasing power, not absolutely flat. It goes up and down inside this valuation range. But you go back to ancient Rome to today, and there's a range of purchasing power that gold has. First of all, M0 incorporates a few different aggregates of the currency supply. What gold backs currently in the monetary system and historically is only the currency in circulation. It backs the Federal Reserve notes. So trying to calculate what it would have to be if it was to cover M2 is absolutely pointless. It's ridiculous because the Federal Reserve does not guarantee all of the bank credit that is created. It's not going to ever cover bank credit. So for anybody to run these calculations of, well, what would it take if gold covered the currency supply? Well, I believe it's about 92% is created by the banks and not the Federal Reserve. And so you have to eliminate that. So those blue bars are basically a pointless exercise. It's never going to happen. It won't. Right now, almost all, how much did we calculate? It was like 99.7% of all America's gold was pledged to the Federal Reserve. And so they have basically a lien on America's gold. And those gold certificates, which could be revalued under this new system that Scott Bessent was talking about, and something like this, I think this might be in our future. It's going to be a giant shock to the global monetary system if it happens. And it's only really going to happen if there's a major crisis, but I see a major crisis coming. So historically, we had Treasury notes, 100% backed by gold. So if you had a note, that was the IOU. If you had a dollar bill or a $20 bill, that was the IOU from the Treasury. And it said there have been deposited in the Treasury of the United States $20 in gold coin payable to the bearer upon demand, right on the note. And so that was the IOU. And a gold standard is self-funding. A gold mining company digs up a bunch of gold, sells it to the Treasury, and the Treasury buys it just by creating the IOUs for it. So they print the currency, and then the gold that they just bought backs the IOU. So it's a self-funding process. It's nothing that has to be taken out of taxes or anything else. But the 40% is the ratio that fell apart during the Great Depression. When the Federal Reserve was established, we went from a 100% gold backing of the currency, the IOUs, to IOUs that were only 40% backed, meaning 60% of the IOUs were fraudulent, that this was a lie. And that's what caused it to fall apart, is because they were lying. So if they pick a 40% reserve ratio, this is the reason I've always said, gold standards suck. Gold is great, but gold standards suck. The lie is what fell apart. And then they didn't establish a by law reserve ratio for the Bretton Woods system. And they just kept on creating currency, and it fell to about 8%. But basically, you and I already did this calculation in one of our videos from April or May, but it was $9,044 to cover 100% of the currency in circulation, not M0. So, by now, maybe we're very close to $10,000 an ounce to go back to what historically was the portion of the currency supply that the U.S. gold covers. But the U.S. Gold, the gold that is supposed to be held in trust for all of the U.S. citizens, is not going to be used to back private bank credit. Banks, they have some rules that they have to live within, and the Federal Reserve can tighten up those rules or loosen up those rules. But there are rules that govern that. Free market factors plus how much headroom does the government want to be able to do deficit spending? Because this really puts a constraint on everything, how much currency you're going to create. They're talking about gold-backed bonds, and they used to have gold-backed bonds before everything fell up, before Roosevelt made private ownership of gold illegal. They had to abrogate, it's called, the gold clause in all of the U.S. Treasury bonds that said they were redeemable in lawful money, which included gold coin.
Yeah, no more lawful money, not in this country.
Right. Right. So for anybody that wants proof of this, just go to the Federal Reserve's website or just do an internet search for Federal Reserve H.4.1 release and scroll to the bottom, and you will see that the only place on the Federal Reserve's balance sheet that the U.S. gold is being used monetarily is to back currency in circulation. That's the last item on the H.4.1 release. And if you take the number of ounces that we've got divided by the currency in circulation, you need $9,044. At least that's what it was when we made a video about it recently, to back the currency in circulation. And that is what they did historically.
Back in the early 70s, when gold was climbing out of the $35 trap, anyone who predicted $400 was ridiculed. Yet the metal didn't stop there. It ran to $873. What looked impossible quickly became history. Mike Maloney says the same dynamic is unfolding today, and this bull market still has a long way to run. The comparisons to the 1970s are everywhere, but Maloney argues that we're still in the early stages. Even if you slice the charts differently, the 70s delivered bigger moves than what we've seen so far. The difference now is the backdrop. Global debt is off the charts, growth is fragile, and currencies are eroding faster than most realize. Despite that, gold hasn't yet seen its full monetary demand surge. What we've had is some FOMO, a bit of cautious accumulation, but nowhere near broad adoption. That gap matters. It means the real fireworks are still ahead. Maloney believes gold can at least double from here, maybe far more. Just like in the 70s, outlandish price targets will be dismissed until they aren't. He also draws a sharp distinction between how emotions manifest in gold versus stocks. Equities usually peak with smooth, rounded tops, only to collapse in a sharp crash. Gold psychology is inverted, rallies spike, fueled by sudden waves of fear, then retreat before the next surge. Flip a gold chart upside down, and it mirrors a stock bubble. Let's get back to the interview.
One of the things I see, at first glance, you're saying, okay, this 2020's bull market is only 76 all-time highs. So basically, compared to 209 of the 70s, we're just getting started. However, I do want to point out that they split today's bull market into two sets of all-time highs, where they have grouped the 70s bull market into just one set. So you'd have to take the 106, add 76 and 106 together, but still, it doesn't matter. The global economy is in a lot more trouble than it was back in the bull markets of the 70s. And gold being a monetary asset, it's really when monetary demand hits. And we haven't had it yet. We've got fear of missing out, which is completely different. That's greed-driven, not fear-driven. And we've got some people getting prepared because they see something dangerous in the road ahead, but not that many. So as a percentage of the population, not that many. Not enough people own gold yet for this to be anywhere near being over with. I think we absolutely have more than a double in gold. I think that, if I had said that $10,000 was possible when I wrote my first book back in 2007 and 8, it came out in 2008, but it was written in 2005, 6, and 7. And if I had said that $10,000 was possible, everybody would have called me absolutely crazy. But one of the things that I've put in both books is that, at the beginning, back in the early 70s, when gold was just leaving $35 an ounce, a lot of economists thought that gold was going to fall in price, not rise, because there wouldn't be any more central bank demand now that it was demonetized, basically. And anybody that predicted that $100 was possible was considered an absolute lunatic. And if you said $200 was possible or $400, it was like tie him up and put him in a rubber room because this guy is really crazy. And we ended up going to 873 intraday. So anyway, early on in bull markets, people point to the people that end up being very accurate, the ones that were actually right, and calling them crazy. And so I still think that there is a lot more room to run. If you take a chart of gold and turn it upside down, it looks more like a chart of the stock market. The stock market has these round distribution dome tops and these real sharp crashes and V bounces that are fear-driven. Gold, it's fear-driven toward the tops. And so you've got these spiky tops that it really does look like an upside down. The gold looks like an upside down stock markets chart. Stock markets look like an upside down gold chart. And it just shows that the dynamics of fear and greed are very different in these two asset classes. Well, the problem here is that the source is World Gold Council and Incrementum AG. And I don't know, did they include ETFs in China and so on? Most likely they don't have that data because the gap between those is most likely made up by people in the East. It's investment coming from China and then the wedding season in India and so on. And so there's something there's two things going on here. That plus central bank buying. That could be one of the reasons for that gap, because the ETF holdings isn't what is putting a floor underneath gold. It's definitely coming from elsewhere. And so this, at the beginning, I said that, it wasn't people. You said that more people have had interest in gold lately. Yeah, a few Westerners, but not that many. It's mostly Asia that was driving this. And I think this is the chart here that sort of shows that it's coming from somewhere else. It's not coming from the retail investor in the United States. Any viewers that don't know, the London Gold Pool was a group of central banks led by the United States. And whenever gold would rise to a significant amount, like when it got up, if it was supposed to be $35 an ounce, that was the official price. That was the price that central banks traded it for. But when the free market price rose above that, and there was a significant enough price differential, this group of central banks, led by the United States, would dump a bunch of gold on the market to cause the price to go down. And it was absolutely emptying the coffers. And the United States was the largest contributor to this because we had the largest stock of gold. And it really did suck a lot of gold away from the United States. And that collapsed as soon as France pulled out and started repatriating. So, okay. And that is what caused. So these three first events are a chain reaction. That is what caused the Nixon shock. Nixon had to take us off of the Bretton Woods system, which was the last connection to some sort of pseudo-phony gold standard, where we only had about 8% gold backing at the time. Because if gold kept on flowing out of the vaults, because under the gold standard, any central bank, any foreigner actually, was allowed to show up at the New York Federal Reserve, and they actually had a window where they would pay out gold for U.S. Federal Reserve notes. So you could cash in your Federal Reserve notes for gold at $35 an ounce. And gold was leaving the United States because of that, because of this chain reaction of events here. It's very interesting. Okay. Yeah. And then, UK and Switzerland. So the UK sold almost all of their gold, right? He's got a very large rectangle there of gold central bank sales. I don't know which one. It would be interesting to just isolate the UK, but I mean, they call it Brown's Bottom. Gordon Brown, I think his first name was Gordon, was Chancellor of the Exchequer or something like that. I can't remember his title. And they sold half of all of their gold at the very bottom, down in the 250s. Scott Bessent and Trump basically said, gold, 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 not Bitcoin. Mm-hmm. Bessent basically said Bitcoin is a risk-on asset. Gold is a risk-off and a risk-on asset. And so basically, when everything is going well and you want to take gambles, those are risk-on assets. Risk-off is where you run for a safe haven. So that's what that was. Those are his words, not mine. So for the Bitcoiner out there, I just want to say that's Scott Bessent's take on it, the Secretary of the Treasury.
Gold ticked higher on Tuesday, but it's still stuck beneath the levels that matter most to traders. The market is basically in wait-and-see mode ahead of this week's Federal Reserve updates. The lift came as the US dollar index slipped 0.1%, giving gold a slight tailwind by making it cheaper for buyers outside the dollar zone. At the same time, bond yields are holding steady or lower, and expectations for a softer Fed stance continue to lean in a dovish direction. That mix sets up a cautiously bullish short-term picture, but only if gold can punch through the resistance lines capping its moves. Until then, it's more drift than breakout. History shows that what once looked unthinkable can quickly become the new baseline, and today's setup has many of the same ingredients that fueled past surges. With debt swelling, currencies weakening, and buyers circling for a breakout, the stage feels set for another dramatic chapter in precious metals. Is the current hesitation simply the calm before a rush that redefines how high gold can go in this cycle? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Additionally, if you are interested in Bitcoin-related news, consider subscribing to our other channel for more updates. Thank you for the support, and I hope you enjoy the video.